If you're like me and you want to invest for your kids, odds are you hear the idea of an IPO and you think, hey, this is an opportunity for me to get in early on a stock that could be low priced or maybe the next big thing, and I can make sure I get it for my kids. In this video, I'm going to encourage you that you should take a second and just hold off. I'm going to show you 5 things you didn't know about an IPO. Hey, what's going on? My name is Maoli Vodi with Financially Present, your one-stop shop for financial and investment education. And here, I want to make sure that I'm looking out for you like a friend, a brother, an uncle, and a father would. Because much like you, I have kids and I want the best for them. And I want to make sure that they have an opportunity to build as well. So there's some certain things that I like to do, especially invest. And you see opportunities like an IPO and you see hype around these companies here and there, and you wonder, what should I do? Should I just throw money into it unknowingly? Should I just jump in? You know, everyone's talking about it, right? There are some things you need to be mindful of when it comes to an IPO. I spent the bulk of my career as a stockbroker and investment consultant, so I've seen a lot of stocks go public. And here are 5 things you didn't know about IPOs. Number 1, the type of investor. They have this definition called a sophisticated investor or accredited investor. And what that simply means is that annually you earn $200,000 or more and your net worth is $1 million or more without including your house. Okay, so your primary residence, you would not include that. So based on those 2 data pieces, they would say you're an accredited investor or you're a sophisticated investor. And the idea with that is that you are able to sustain any ups or downs, or to withstand any ups and downs in an investment that could go sideways or other negative ways, right? So a sophisticated investor is someone who they believe can comfortably invest in things like IPOs, unregistered securities, even capital raisings for private firms and other investment styles or types, and even hedge funds. And that effectively does box out a lot of people. The only alternative for that was to make sure you can demonstrate your professional knowledge or understanding of these concepts or have industry experience with these things. So those were the only 2 qualifiers, your income or your knowledge. And if you didn't have either one of those, then you were not considered a sophisticated investor or an accredited investor. This was the case all the way up until August 2020, where the SEC changed this definition or allowed some alternative views on this point, and have kind of opened the doors for exceptions, right? So now that creates this space where people can comfortably invest, whether they're comfortable or not, in unregistered securities, IPOs, and the like. Number 2, there are different types of IPOs. You're going to hear of direct listings, you're going to hear of SPACs, which are special purpose acquisition companies, and then you're also going to hear about the traditional IPO or the initial public offering. And they all vary in timelines. The traditional IPO process can take a lot longer, maybe a few months to a year. SPAC process, it really depends. And then the direct listing offer, it could honestly take maybe just a few weeks. It really depends, but they all vary. Direct listing, imagine you're already a private shareholder and they decide that they don't need an intermediary or they don't need a in-between to help you go public. So they're not going to hire a big name bank to help with the underwriting process, and they don't want to have to pay a fee to that underwriting bank. So they just go and directly list it on the exchange along with new and additional shares. So with this process, they still have to register and do all of the appropriate paperwork, but it's much simpler. Then there's SPACs, that's the special purpose acquisition company I referred to. And basically, think of it as a blank check company. It's a company specifically designed to acquire a private company and effectively take them public. So it's essentially you have warrants that will eventually be exercised into the common shares of the new company that the SPAC acquires. A lot of companies are trying to do that because it's a much quicker process. It's cleaner in a sense, and you just don't have to wait as long. There's not this hype. You don't have to pay the fee to an underwriter. All of that's already been taken care of because the SPAC is designed to acquire. Then lastly, there's the traditional IPO process. This is that dog and pony show. It takes a long time for this process to happen. They invite banks to help underwrite. They have to pay a fee to those banks. So the price that you're going to get for the IPO after it actually goes public is going to help pay for that fee. And the IPO process, the traditional one, is going to be much longer because they're spreading more awareness. You're going to see more hype in the news, a lot of headlines, and a lot of anticipation leading up to it. Because an IPO at the end of the day is a fundraiser. Okay, for the company that is going public, they are making some money initially, and then after that, the shares are traded in the public market for regular, everyday people like yourself and myself, along in the same market with institutional buyers and so on. The third thing that you didn't know about an IPO is that it's a wild guess. These companies that are going public, they hire, especially in the traditional process, a underwriting firm or a big name bank, but they also will hire research teams, and they will work with mergers and acquisition specialists, all for the fact that there is no one way to calculate the value of a company. And the numbers that you see that they projected the stock is going to be it's made up. It is their best guess as to what they think the value is of the company, with the thought that they have to get paid out of this as well. So no one truly knows the value of the company until it's actually exposed to the market and is traded by regular everyday people. There's institutional buyers as well, but when regular people like you and me are buying the shares, that truly speaks to the value of the shares or the stock in the company as a whole. But no one truly knows. So all they can do is really guess. They put a lot of money into this guess, but it is a best guess, and that's all they can do. Number 4, most IPOs are unsuccessful. Look, SoFi.com did an analysis of NASDAQ companies that have IPO'd since 1980. And of all of those, only 20% were deemed to be successful IPOs. So basically 1 out of every 5 IPOs was successful. The rest, not so much. And in that same analysis, it said that 2/3 of these companies that IPO'd between 1980 and now underperformed the market. So statistically, IPOs are not going to do well. And it's up to you as an investor to decide, hey, is this something I'm willing to risk it on? Number 5, the early investors get an opportunity to leave. So remember I said that an IPO is generally a fundraiser. Well, it's not the earliest stage of the fundraiser. There are people who are, let's say, venture capitalists that have been betting on this company, maybe even for years, or employees that have had privately held shares for years. And now that the stock's going public, they finally have their opportunity to release those shares or sell them so that they can finally cash in. There's generally a 30-day lockup period when a stock IPOs, but after that 30-day mark is where we truly see the value of the company. And this is for traditional IPOs only, where you see that 30-day lockup period. But once the 30 days is up, the stock is now marginable, meaning that the shares have loan value, options trading can begin, and people who got in early on the IPO, at the IPO process, can finally sell their shares, because if they sold them sooner than that, it would make the shares tank in a sense, or drop suddenly. And people who were in even earlier, the venture capitalists and the people who had privately held shares, now that they have their opportunity to sell, they're going to take that opportunity. They may or may not sell all, right? There could just be a few, but now they have an opportunity to exit while you're entering. And that doesn't always bode very well for investors. So it's still ultimately up to you as to what you're gonna do when an IPO comes around. So now that you know 5 new facts, what are you gonna do? Are you still gonna invest in the next IPO that you hear about? I'd love to hear your answers in the comments below. If any of what I've said is a little confusing or you need kind of a rundown of investment education, I want you to check out some of the links below to help you further your education. And lastly, if you like this video, I want you to hit that like button, subscribe if you're new to the page, and turn on notifications so that you don't miss out on future content. And until next time, stay present.